And this way we can go ahead and get started. And anybody who joins a little bit late can see the replay, but I think we have a lot of stuff to cover today. It's very interesting. It's going to get a little nerdy at times, but I want to make sure that we have enough time to go through everything. And if you guys have questions along the way, feel free to fire them off. This is probably going to be one of the more technical ones that we go through. So feel free to ask questions along the way if you feel like if you need some extra explanation. Okay. So welcome to part 3 of the Apartment 101 series. So the previous 2 that we had, it was Apartment 101, a quick basics of overview of apartments. And the second one is basically the purchase, the life cycle of an apartment purchase to apartment sale. So now we'll be diving into a little bit more detail, and also give me a second. Some people are reporting that the Zoom link is not working. I think that's because you have to actually copy and paste. Give me a second. Let me just tell people. Let me just go ahead and send everybody email. General house cleaning work. Give me a second. Okay. All right, let's keep going. So standard disclaimer. So we're not brokers, we're not agents or attorneys. Nothing we say here constitutes legal advice. Also, we're not trying to sell anything in this meetup. This is mainly for educational purposes. So as many of you know that, from time to time, we will buy new properties. And so if you're interested in being notified when a deal becomes available, or you want to get the latest news about the market updates, etc., please feel free to join our mailing list. It is bit.ly /link newsletter. Okay. That's the best way to reach us. That's the best way to sign up, and yeah, I'll copy in the chat. In fact, I'll probably should be able to type it in. So feel free to reach out to us over here. All right, so moving on. A little bit about the upcoming events. Like I mentioned, we already have apartments 101 and 102. Replays are available for those sessions. So feel free to, you can just ping me or send me a message on Meetup, and we can provide you the replays for that. Okay. So this session is on underwriting deals. If this one runs long, I can always hold a second one to dive into more details. Okay. So we'll also, coming up, we'll probably switch gears, and I will go over, for a property that we're recently selling. So it was a 3-year hold, and we managed to sell for a pretty good price. So this would be a good target to do a case study on, to see how we purchase, how did the process goes, and everything. Okay. The next one will be on commercial lending. That's probably gonna start heading into next year, and how to manage large size properties, right? And finally, I think one of the things that everybody's asking about is like, how did I transition from single family to multifamily? So we'll be sure to do we'll be sure to do a meetup on that as well. Okay, so quick agenda for today. We'll do a quick introduction about us, Link Multifamily, and we'll also talk about the different type of multifamily deals, how to analyze it, and how to do your own underwriting to make sure you understand the deal, make sure you understand what you're actually investing in. Okay, so very helpful, especially if you want to one day also purchase multifamily. This is like really useful information to know. People charge $25,000 to be in the club to teach you this, but I don't believe in that. So I'm more than happy to share these with you. So a little bit about us. We're a group of investors. We focus primarily in out-of-state commercial property. So right now, most of our investments is in Texas, although we're also starting to spread out to different states. So far, we have acquired around $35 million of assets, about 350 units. And so we obviously, none of us can buy a $10 million apartment alone. So, but together we're able to take down larger scale institutional size properties. So far we have raised around $6 million in funding, and we're always looking for more deals for people to come with us on the journey. Okay. So far our investment club is actually over 1,000 people now and growing. So it behooves me to look for larger and larger deals so that everybody can actually join in on the deals. Okay. I think, can everybody put yourself on mute? I think by default is not being muted. Just go ahead and do that for a few of them. Okay, thank you. Okay, so one good news is, so one of our properties that we bought 3 years ago, in 2018, we bought it for 11.7 million. And very happy to say that, the property is actually under contract now. So it's looking to close beginning next year, but we originally acquired it for 11.7. We probably put around close to $4 million in as an investment from the group ourselves. And yeah, we're now under contract to sell for over $17 million, which is really, really good. This is a Class C property, but it cash flows like crazy. It's a very profitable property. After we took over, we pretty much increased the income by over 20%. And that's what is driving the price so high. I also plan to probably do a meetup on, like I mentioned, a case study on how we were able to go from the purchase price of 11.7, which is like about $83 a door, $83,000 a door, to selling it to pretty much close to $120,000 a door. Okay, so a little about me. I'm Tony.
You're not gonna go to eat later.
So so I'm a full-time techie. Okay, so over 20 years in startups in Silicon Valley. I love building software. That's why I'm still at it. I just really enjoy learning new things. And I was fortunate enough to be in 2 tech IPOs. One is Aruba Wireless, which is now acquired by HP. And another company is called Eltion, which was acquired by Nortel. So I took some of those money and, was looking, just like everybody else was looking at where I can invest some of those funds. So I started by investing in real estate overseas. So I was investing in flats in Beijing as well as other parts of China. However, China is very volatile. Politics and policy changes all the time. So I decided to move my investments back to the stateside. And after evaluating many different types of investments, I settled on investing primarily in apartments. Okay, so far I've invested in about 12 different deals. So over 4,000 apartment units in Texas, in Arizona, and also now in Indiana. I also have other investments such as self-storage, a student housing, and a new build project, right? Interestingly enough, I also have a commercial service business that I'm invested in LA. So I try to check out different type of investments, try them out, and see which one fits my profile and which ones have the promised returns. Okay. So after investing in so many apartment units, so I gained a lot of experience, met a lot of people, and was able to build up an acquisition team. And so we started to acquire properties. So far, I am partnered in 3 multifamily projects, all of them in Texas, totaling over 580 units. So, totally around $55 million in assets. And we just sold one, so it's a very successful full cycle exit. We only held it for 3 years. Original plan was to hold it for 6 years, but we got a pretty good return in just 3 years, so we decided to sell the property. Okay. My partner is Aziz Laliani. He's also on the call today. So Aziz brings a lot of experience to the table. He's an executive in the Silicon Valley, worked for many large companies. And he's also a serial entrepreneur, having started many tech startups. You probably use some of his products today. So on the side, Aziz also invested in a lot of different assets. So he's invested in oil and gas, hotel, and real estate outside of California, inside, right? So he's been doing this a lot longer than I am, and he has much broader breadth of knowledge. So I think I'm super blessed to have him as a partner, and as a great advisor to the team. So Aziz also have been acquiring multifamily, investing in multifamily. So he's been investing in out-of-state multifamily since 2017 as well. Okay. So we invest in apartments, right? There's many reasons why invest in apartments. So over here, you can see the different classes of apartments. So class A is basically, anywhere from 10 to 20 years old. Your Santana Rows, your brand new Mission Bay type of things, right? Super nice, but also a little risky, because in a downturn, they tend to be the first one to, have some rent dropping or to retain tenants. Okay, so we saw that in the past COVID cycle, that the brand new class A's were suffering quite a bit. Okay, have to give like almost a month or 2-month concession, but we didn't see that so much in the A- space. Basically, properties that were already stabilized, that were built around year 2005 or so, right? So that's a space that we're starting to look into. With the pricing starting to be pretty close between B and A, we're looking at basically class B and class A minuses. And these tend to be the more affordable options compared to like a brand new build class A that wants to charge you $4,000 for like a 2-bedroom, right? So my usual investment philosophy is look for assets that will continue to do well, even when the economy is not doing good. So as we saw during downturns, during the previous downturn and COVID, the Class B and Class C and the A minus of the assets have endured extremely well. I think overall, through the whole COVID, we held at over 92% occupancy and easily over 90% in terms of collections. That's just the thing, people always need a place to live. When the shit hits the fan, people will sell the car, people will stop going to restaurants, but they will always try to pay the rent because nobody wants to be evicted and for not paying rent during during COVID times. So, but things are very different, all right, between California and a state like Texas. Texas is extremely landlord friendly. In California, you're gonna have trouble trying to kick somebody out. It'll probably take you a year and a half or 2 years to even try to kick somebody out in this COVID environment. In Texas, we were still able to continue to evict people who haven't been paying. So on average, we can still evict them after a month. So that's been very effective. So that's why it's very important to invest in a landlord-friendly state. Yeah. Okay. So the general idea for us on these acquisition is we buy them and we will renovate them. We do what's called a light renovation, where we're not doing a huge turn, we're not moving walls, we're not knocking them down. We do light, easy renovations, and then we're able to push rent by $50 or $100, right? So typically, a deal like this starts out with units that just completely classic, right? White appliances, everything looks old. After renovation, the whole unit looks a lot better. And we can do these kind of renovations for only about $3,000 per unit. And this is really because of the scale of the apartments, right? So when we're doing this when we're buying refrigerators, we're buying 200 of them, right? When we buy granite, we're buying like, over 100 slabs, okay? So things become much cheaper when it goes to scale, right? So I think I mentioned before, the granite, this type of granite, a slab of granite is only $99, okay? Backsplash, we put on the backsplash for about $60. Appliances are around like $1,500 for a whole set that includes fridge, stove, and dishwasher, right? And to change out the whole flooring is about $1 a square feet, right? So compared to single families, when you're doing things in apartments at scale, it becomes much, much cheaper, right? So $3,000-4,000, you can renovate the whole thing. Right now, we're pushing it even further. So for example, we will change out these cabinet fronts for the nicer shaker style cabinets. We are also, we can also put in stainless steel appliances, but not a full stainless, like a stainless front, okay, for just a little bit more money, but it looks much better, okay. So, and then there's all the other stuff that we can put in, such as a tech package, etc. Right? So, plenty of options to to upgrade, and the cost is very, very little. Okay. Any questions here before I move on? Yeah. So if you want more details about like all the things that we do, please, you can either take a look at the Apartment 101 replay, or you can come to the Arbiters case study and then we'll show you exactly how we do it. Cool. All right. So the topic of today is really underwriting, right? So underwriting is the process of coming up with a projection for your business plan. Okay. So it's good to understand this because then you know what you're investing into, what knobs the sponsors are tweaking in order to make the numbers look better, right? And also, for you when you're looking at deals, how to do a very quick analysis. Okay, so I'll start off by kind of going from a passive investor point of view. Okay, remember I invested in like over 12 deals, and I looked at least 200 plus deals, and also properties to purchase. So lots and lots of experience, and there's a lot of interesting things I've seen. Okay. So for me, if I was a passive, I'm continuing to make passive investments, by the way. So for me, the most important thing is the people first. Okay. I really want to know and be able to trust the sponsors, because I may not be an expert in self-storage. I may not be an expert in senior housing or a retail mall, right? But if this person has been doing it a long time and he knows the ins and the outs of it, he knows what he's looking at, and I feel like this person is trustworthy, that's the first thing that I look at, right? That is the most important thing, because we are relying on other people's expertise in their field to make good judgments and be able to hit the pro forma they have projected, right? To hit the kind of returns that they are talking about. Then, armed with the knowledge that you guys will get today, you'll learn to see how you can look at the numbers that they're presenting and whether or not that actually constitute it's a good deal or not, right? Because a lot of people will underwrite deals in such a way that something that will look nominally at a 12% return a year, you can underwrite it with like, I'm going to have a rent growth of 30% a year, right? And housing prices are going to increase minimum of 15% a year. And then I'm going to get you guys 30% a year return a year. It's all BS, right? But once you know what are the typical numbers to look for, you'll be able to filter out people who just constantly inflate numbers in order to attract money. Okay. So when I look at deals, I look at deals that are conservative, okay? Meaning that, I'll give an example. So for example, Dallas over the past year saw a rent growth of over 15%, okay? Now, should you be underwriting 15% rent growth for every year after that? No, you absolutely should not. So a conservative person knows like the general trend of the market over the past 3-4 years. What does that look like? Okay, so instead of underwriting for 15% rent growth going forward, they'll underwrite a more conservative like 3% or 4%. That's achievable, right? So the good sponsors that I work with are very conservative. They don't overpromise, but they want to consistently hit their projections and over deliver. That's the type of person that I like. Okay. And there's also different investment types, okay? Even among apartments itself, there's different types of investments that can be made, something like a brand new apartment build, or something like a very old and trashy place, built in 1920s, before World War, and then you're doing a full gut, right? Each of these carry a different risk profile and obviously different returns. So, find a type of investments that fits your risk profile. I think is very important. You should never look at a return without factoring in the risk associated with it. Okay. And finally, I want to, see the syndication's track record. Okay. It may be that, this one person that is starting out doesn't have a lot of experience, but he's probably partnering with some other group that has a lot more experience that will be able to manage it together with him, okay, which lessens the risk. So people are always starting out. And what I find is that people who are starting out work the hardest. Okay. But it's hard for people starting out to get off the ground. So if you don't have experience, that's perfectly fine. You can partner with somebody who has the experience to back you up. Right. So it's a track record is very important. Okay. Somebody in that partnership must be very experienced and be able to know how to guide the ship. Okay. Also, the number of acquisitions that they had before is important, right? So somebody who has never acquired property is riskier than somebody in the group that has acquired 5 or 10 properties before. Okay, but I will caution this, okay? Originally, what I had this on this slide was the speed of acquisition. Okay, so I think in the last 2 years, we've seen some deals fall apart because some sponsor groups got too greedy. So for example, there's a group that I was investing in Arizona. They're doing great, right? So in the past 2 years, they were able to flip properties for a large profit. So a lot of people started investing with them, but then they became too greedy. So what happened was, then within 1 year, when I invested with them, they had about 5 properties. Okay. After I invested with them, they went from 5 properties to 15 within 1 year. There's just no way. There's just no way that their team can scale to a point that they can be able to commit enough energy to watching all 15 properties. They'll be spread so thin. And now I'm actually very worried about my investment. Okay. So be careful about people who is scaling too fast. Okay. That's how you get in trouble. Because they're just, it could be 2 people starting out with this partnership and they're both very experienced. They're able to manage maybe 4 properties really well at the same time. But, once you get to like 10 and then still the same 2 people managing it, it's going to fall apart, right? And this has happened twice in the past year. So be careful about people who are too successful. So I generally think that, for groups, if they acquire 1 deal or 2 deal a year, that's usually a good pace. Okay, so we invest for returns, right? So we invest to make money. But what are some of the metrics that we usually look for? Okay, so the one that everybody knows about is cash flow, right? So we invest $100,000. If we can get 6% cash flow, that means I'm getting $6,000 in back every year, right? On my investment, which is great, right? So that's all, but however, that's only one component. Okay. When just like when you're flipping a house or when you're adding value to a property, okay, you're adding value to the property that's not related to the market. So appreciation comes in 2 forms: forced and market, right? So a market appreciation is really, hey, my house went up by 10% year over year. Did I do anything to cause that? No. Am I able to do anything to help the market go up in price? Not really. Okay, it's out of your control. Okay, so that's normal appreciation. Forced appreciation is when you make improvements inside the property that force the value of the property to be increased. Okay, so things like the renovations that we did before that allow us to collect more money, right? Things like renovating your single family home to have a beautiful kitchen, and now your house is worth more money. So that's forced appreciation. Okay, and in apartments, which is really a business, the amount of improvements that translates to value appreciation is predictable. Okay, so and I'll show you that. And that's one thing I like about apartments. we usually don't depend on the market driving the prices higher. That's a nice bonus, but we never count on that. We only count on what are the cash flow that we can achieve and how much extra value we can force by doing improvements. Okay. The next thing that you want to know about this investment is how long is the hold, right? So typically, for apartment deals right now, it's about, anywhere from 5 to 6 years. That's the target. That doesn't mean that it won't sell until 6 years. If we're able to achieve much better returns, we'll sell early, right? If we have an extended downturn, like a dot-com bust, then we might hold it for longer until the market recovers, right? So it really depends on, so the 6 years is a usual guideline to kind of see whether we can double people's money. Okay, but like I said, for arbitraries, our original projection was 6 years, and now is a great timing for the market, so we're selling at year 3. Okay, but usually the sponsors, basically the people who lead the deals, the sponsors would recommend to the investment group when is a good time to sell. Okay, so for example, like now is a good time to sell. And then all the passive investors will get a chance to vote on whether they want to sell or not. And maybe some people want to hold on to it for the continued cash flow, right? Maybe some people just want to sell the property and so they can go buy a boat. Okay, so but it's up to the syndication group. So at least in the deals that I invest in, they always have a clause for investors to be able to vote when it comes to a liquidation event, whether to refinance, whether to sell, or whether to hold. Okay. And then finally, so for example, if the projection is in 6 years, we will double your original investment, right? Everybody will get, if you put 100 grand, you'll get 200 grand back. Okay. Then that kind of translates to an annual rate of return. Okay. Let's say 16% is the annual return average. Okay. So, I mean, most of the time we look at investments by looking at the annual rate of return, because some deals doesn't go full 6 years, right? Maybe it goes 3 years, maybe it goes 7 years. So looking at what type of return we're able to get annually by adding up both the cash flow and the appreciation piece, that's a more realistic way to see my overall return. Okay. So moving on, so before we look at the details of these type of apartment investments, how to underwrite them, we need to understand the different characteristics of different investments, right? So there's mainly 3 kinds, okay? There's one called yield play, there's one called value add, and there's one that's in the middle, which is hybrid. So a yield play is basically like if you buy a Class A property, okay, there's literally nothing for you to renovate because it's brand new, okay? But good news is there's no maintenance. There's nothing that will, probably nothing will break, but there's also no forced depreciation upside, right? Because everything's already new. So it's just a very stable cash flow that you hold for a much longer term. Okay, so a lot of elderly like this, so they're retired, they want to buy into a high quality asset and hold it for 10 years, 15 years. And the cash flow that this property throws off, that's basically their retirement fund, right? So they can continue to have a almost like a fixed income, right, for the long term. So in order to hold a long term, you want a newer property with less problems. Okay. So renovations, you pretty much don't buy anything. In this case, you're probably buying a brand new apartment that's built in 2020 or built in 2021. Okay. So large private equity, they love to buy these kind of assets, and then they'll just hold on to it for like 15 years, right? Their investors are not so worried about a quick return of money. They mainly want a stable cash flow and a more guaranteed return in the long run. Okay. So forced appreciation, well, there's no forced appreciation, okay, because you're not renovating it, okay, you're just going along with the market. Okay, so because these are safer plays, because these are lower risk, there's nothing to improve, their overall return is much lower, okay, so 9%. So you're kind of trading safety for lower return, right? Higher risk, high reward, lower risk, lower return. It's, what you feel like. On the other extreme of the spectrum is the value add. Okay, so think of these as your fixer uppers. You're buying in the hood, a building is falling apart, and then you're literally going there. You're probably, doing significant renovations, tearing out all the pipes, right? Changing out all the walls. So very expensive renovations per unit. Okay. I mean, I've seen anywhere from $10,000 a door to $20,000 a door to do a full renovation, right? So these are very high risk because, it's almost like a construction project, okay? In the first couple of years, you're not going to see much cash flow because, you're overhauling maybe 50% of the units, right? And during that time, it's not a turn. I mean, it'll take you like a month to 2 months to turn one of the units. During this time, nobody's living there, right? And while a major construction is going on, no tenants want to be in the construction zone. So for these type of value adds, you'll see occupancy go from like 100% down to like 50% or even lower, okay, while this is going on. So annual cash flow is much lower, but you're basically relying on the forced appreciation at the end. So some of these projects like to present a much higher return. They would sometimes say like it's 20% return or 25% return on new builds, and but yeah, it's high because it's risky, and they're trying to attract people who's willing to take that risk, right? So they had to keep jacking up the return to make it look attractive. Historically, too big of a flip usually doesn't end well. So they run into a lot of problems. Okay. The type of investments that we do are what are called hybrid. Okay, so these are light renovations. We're looking for deals that is cash flowing as soon as we buy the property. Okay, so we have some buffer built in on day one because it's already profitable. The property that we buy is already profitable. Okay, but we still have the opportunity to do some light renovation on it. Okay, so we usually hold these, 3 to 6 years, a little bit longer. Value adds, you probably only hold on for like a year or two. You go in there, you massively upgrade the place, and then you try to sell it very quickly, right? Because the loans are usually very short. So for hybrid deals, renovations or light renovation for, right nowadays, maybe a little bit more expensive. So about $4,000, okay, $4,000, $5,000 if you do cabinets, okay. Usually going in day one, we can get about 5% cash flow, okay. And over the years, through your value add, you'll also get an additional force appreciation, about 9%. So what I'm seeing in the market nowadays is, anywhere from 12 to 14% return annually for these type of hybrid deals. And for reference, so this Arbor Terrace is a hybrid deal. Okay, so even though things look old, but it was already profitable the day one that we buy it. And then we spend about $3,000 over here to renovate the unit, and we're able to do force appreciation on it. We didn't touch the walls. We didn't even take down these. We didn't even take down, these closets and stuff, these cabinets, right? So we just repainted it. That's all we did. It's the same cabinet, right? So, okay. So for me, in terms of my tolerance level, I like cash flow, but I also like to have upside. Okay, we also like to have the upside potential of the force appreciation. And we were able to, even though I think we projected like about 13% return to our investors, we were able to get much higher returns than that when we actually sold the property. So what you'll find is conservative sponsors would underestimate the kind of returns that they can get to make sure that they can hit it every single time, right? Yeah. Pause here for some questions very quickly. So one question, would you ever hold value add property for long term by updating and improving the rent? Yes. So in fact, in one of my first investments, that's what we did. We invested in 2 Class B properties, and then we renovated and then we improved it. The cash flow became so good that we just held on to it without selling it. It literally went to about 14 to 15% cash flow a year, right? So what we did there is, instead of selling the property, we actually refinanced it and paid and basically returned people's original investment back. So if you had invested 100 grand, the refinance would have gave you back 60 grand of that investment. And then you also had other cash flow. So as it stands right now, those 2 properties are still there. We still have those 2 properties. So investors like me, we already got our full original investment back. Okay, so we have nothing in the deal anymore, but we're still getting like 8% cash flow. Okay, and then we haven't even sold the properties yet. So that is a major home run. We got our money back, still getting cash flow, and down the road when we think that it's time, we'll sell the property. So yeah, when it makes sense, we'll definitely hold on to it long term, especially if the people in the partnership votes that way, right? But I think that's the ideal thing. If we can just return you everything, so then your return becomes infinite because you put 0 money in, but you're getting unlimited returns. Okay. Second question, would you say that it is getting more competitive in the market? Yes, it's extremely competitive right now. So I would say that on any given deal, you're seeing, so for like a $20 million deal, you're gonna see anywhere from 20, from 15 to like 20, 25 offers. Okay, there's that many people buying $20 million deals. It's nuts. And this is because of 2 factors. Okay, one is there has been a lot of money coming from different investment types into multifamily. So if you take a look, hotels, right? Hotels did really bad during COVID. Okay. Retail also suffered a lot during COVID, right? And also, if you look at office space, right? So these type of commercial real estate did pretty poorly. So the people that were investing in these type of assets during that time are now trying to move their money into multifamily, because what people realized is during COVID, multifamily was basically unaffected. So they're moving it into a better, a higher quality type of assets, right? So another part is, when the COVID first started, people with money were actually gearing up. With COVID, there's going to be a lot of fire sales, right? So let's go ahead and raise like a $5 billion fund. We'll just go out and just buy everything we can, right, on sale. That didn't happen. There was no discount. Multifamily did so well that, and single family homes did so well that there wasn't any discounts out there. However, these companies have this gigantic fund. They have all these money sitting on the sideline that they don't know what to do with. They have to get it invested. So then they started to buy things up at no matter the price. They have to deploy their funds. Okay. And then third of all is the rent growth. We're just seeing tremendous rent growth in basically middle America cities. Okay. So people are moving from coastal into Texas into cheaper areas, right? So there's tremendous population growth, and they're not building any more Class B properties. So the rents have been going sky high. So that's what's driving the price, and that's what's driving so much of the competition. Yeah, it is harder to find deals, but we're still able to find them. It's just, whether or not you feel like the price is at a point that will make money for your investors, right? So we only bid up to a point where it makes sense, right? If some guy from a private equity fund is just gonna throw money at the deal to win it, we're not gonna buy it just for the sake of buying it. We're buying it as a business that's profitable. So Amir said that for most of your properties, do you have a property management company to manage and handle tenants? Yes. I would say anything over 60 units, you need a professional property management company to run the operations. Okay. So because you're going to want dedicated leasing agent in the office, you want a dedicated maintenance guy in the property. Okay. So yeah. So in fact, the lender is going to make sure that you have a professional property management company there. Okay. Because it's usually the mom and pop shops that try to manage it themselves that get into trouble. Okay. So the lender will make sure that, you're working with a good one. Okay. So for me, for all of our properties, we've been using one of the largest property management company in Texas. Their name is Weiner Multifamily. So they manage about 27,000 units in Texas. And so that's about 170 apartments. So they're really big and they're pretty experienced. So yeah. Okay. Interesting question. How do you deal with full-time product managers, property managers colluding with contractors, where contractors bid up the price on the job and give a kickback to the property manager? So that happens less often in commercial real estate. So for example, if I have an AC unit, or a boiler that I want replaced, we get a minimum of 3 bids. Okay. So first of all, the property management company has a list of approved vendors. Okay. So a vendor really wants to get on this list, because once they get on this list, there's over 100 properties that they can work on. It's endless supply of business. So they're willing, in order to break into this market, they're willing to give very competitive rates, make sure the quality work is good. Otherwise, they get kicked out and then they lose all their sources of revenue. So we always get multiple bids, including bids that are not part of the approved list, and we price check, right? And this way, we never just go with the one that the property management company recommends. So we always comparison shop. And then if we consistently find that the outside people are doing it better than the than the one that the property management company is using, then we will probably switch property management companies. But in this business, once you're a little bit bigger, it's all about reputation. So the property management company would not risk trying to get a little bit of this kickback, and risk their entire business model. So yeah. Okay. Cool. Did somebody have a question? Okay.
Hey, Tony. Daniel here. Another question to tack on is, as you are finding it more difficult to kind of enter into the market and you have a limit to what you are going to bid at, do you have any suggestions for people like me who might not have as much capital or experience? Is it just to join onto a group and see if we could learn as much as possible and hope for good entry points?
Yeah, so I see there's two ways to do it. One way is, in the larger metros such as Dallas, Austin, it's mainly established players that's winning the deals, right? They have a relationship with the brokers, they know the lenders, and to be honest, Aziz and I, we have unfair advantages when bidding, right? Because we know the brokers, we have insider, information that gets passed to us, right? When we're bidding on deals. So what we're finding is that the smaller investors have more success in like a secondary or tertiary market. Okay, so you don't have to compete in the main market like with the larger players, right? If you go into like a secondary market such as Waco or a tertiary market, things are much cheaper there. There's not as much competition, and you can buy a larger, with your funds you can probably buy more units, which will actually make you more efficient. So that's one way. The other way is, partner with somebody who's experienced. That's how I got started. So I went from a single family home to my first purchase was, I went from 1 unit, which is a single family, to 146, right? And that's because I was able to build a lot of experience through my passive investments. So I first invested in some deals to see how they operate, learn and build a team around that. And once I have an experience, I have something to offer those partners, right? I can take the load of running the apartment. I can take the load of helping to manage investors. I have a lot more to offer. That's why they would take me on as a partner. So, and then at that point, that propels me from 146 to 210 units, and so on and so forth. And you don't really have to struggle your way through. So, in my opinion, that's a really great way to learn, right? So, you can, you can join a guru group and have them teach you how to do it, or you can make an investment, a passive investment in one of these deals, and then watch exactly how it gets operated day to day, right? And hear about, from the monthly updates, or, talking to the syndicators, like, what are all the different things that's going wrong at the property, right? That's the real way to learn, in my opinion. So I did, close to 3 years of that before I started buying my own deals. And I thought that the knowledge was invaluable.
Great. Thank you so much, Tony.
Sure. Cool. Yeah, so as I mentioned, Most people like the hybrid deals. Majority of the deals you see out there are gonna be hybrid, but it's less and less, right? I'm looking at some apartments that probably have been flipped, changed hands 3 times in the last 10 years, right? But there's always something new you can do to refresh it, right? Just think about if you went to like a Hilton, okay? What was cool 10 years ago, when you go in, you probably go like, ooh, this feels old. And then they always have come up with a new, more modern, more lighter coloring scheme. And you go, wow, this is such a new property, right? It feels really nice. I'm willing to pay extra for this modern look, right? So every 10 years or so, a property can be renovated because the style, the amenities that people are looking for have moved on. Okay. All right. So here's a quick example of what a purchase could look like, just to get the key parameters in place. So for example, let's say we're buying a property for $10 million, right? So it's 100 units, right? So then the price per door is $100,000. Easy enough. But that's frequently how we kind of judge whether or not the price for this property is high or low, right? So for example, Class B properties in Dallas is probably going for around $150,000 a door. Okay. If we see a deal that's in $130,000, ooh, that's cheap. Okay, should jump on that. If you see somebody asking for $170,000 a door, then you're going like, that guy's crazy. That guy thinks that he's gonna get top of the market prices, and maybe that's a deal that you're not gonna go for, right? So the price per door becomes a very useful metric. You kind of know that, okay, the Class B trades around 150. Class C property in this area is probably around $120,000 a door. Class A, you're probably looking at $230,000 a door. So you have a rough idea about that, and then you kind of adjust it up and down depending on the neighborhoods and stuff, right? So, but this is the first quick metric. Whenever we hear a deal come on the market, we get a very quick feel about whether the price is high or low, right? So it's not like we stop after this, because there's usually a reason why it's low, and there's usually a reason why it's high, right? So for example, if a property has a lot of upgrade potential, it's next to a highway with high visibility, yeah, they're gonna ask for more, right? If it's in a crappy neighborhood, with a lot of undesirable tenants, even though it's a same year built or whatever, they're gonna only be asking for 120 a door, right? So it's usually not too far off. So, but this is a quick metric to measure. And then we kind of go into the financials of a property. Okay, so for example, we'll go ahead and take a look and say, okay, so it has about $1 million worth of raw income. Okay, and then so that's about $900 average rent for this property. Okay, and then their expense is at about $550,000. Okay, then we go, okay, so the expense ratio, the expense to income ratio is about 51%. That's not bad. Okay, that's normal. So normal expense ratio for apartments is around 50%. Okay, if it's a Class A, property, well, there's less maintenance, so it's probably going to be closer to about 45%. Okay, if it's a Class C, it's old, there's a lot of things, things are all going to break at once, then your expense is probably going to be closer to 60%. Okay, so so we look at this, and then if we see that for a Class B property, the expense ratio is like 65%, then we go, yes. Because they're running it very inefficiently. Okay, they are probably overspending on payroll. They are probably paying some guy like $1,000 just to mow the grass, right? There's a lot of things that we're very good at, where we can bring the cost down and run it efficiently. Okay. Usually I see the most crazy things that people do is because they don't know how to set up their property. They spend like over 100 grand on advertising. Okay. They spend so much money on advertising just to try to get tenants to come in and lease, right? However, if you have a very attractive property that you're managing well, you're giving the kind of product that people want, people will come naturally. You don't have to spend all that much money on advertising. So it's about experience. It's about like your ability to execute. So when we see that somebody has a very high expense ratio, it usually means that there's profit there. Okay, you can run it better. On the other hand, if you see somebody running a Class B property at a 40% expense ratio, that's a danger sign. Okay, that's a major danger sign. That means they're saving money by probably not fixing things, by not keeping up the property. The roof probably has a leak, but they rather not fix it. Okay, so all these kind of things is, then you know that once you take over the property, all these problems are going to come back to you. Okay, so we stay away from that kind of asset where the expense ratio is just unreasonably low. So, and then this calculates into NOI. So it's basically income minus expense is what's called NOI, net operating income. Okay, so in a business, there's operating expenses and then there's capital Capex, right? There's OPEX and Capex. So OPEX is expenses that you incur basically as you're running the business, okay? And that will all constantly show up, right? So for example, like your gardener bill, for example, your electricity bill, everyday things like toilet, a toilet breaks or, there's a leak here and there. Well, that's normal everyday operations. Okay, so that's an ongoing expense. So that's considered what we call top of a line. Okay, it's OPEX. Okay, operational expense. However, there's things that's called Capex, right, which is capital improvement. These are one-time large projects. Okay, so for example, I'm gonna go in there, I'm gonna paint the whole building yellow, okay, to improve my attention grabbing. Okay, well, that's one-time capital improvement. I could be going there and I could be building like 20 garages along the side, right? So that I can rent them out. Well, that's a Capex. You're not building 20 garages every month, right? So, when we calculate the income and expense, we're calculating the operating expense. So NOI stands for net operating income. Okay, so in this case, it has a net operating income of $530,000 a month. Okay, and then we move on to the more of a below the line items, right? So you will then subtract your mortgage, you subtract your capital improvement that you've done over the year, and then this is your real cash flow that you get. Okay, so the real cash flow that you get is $180,000. Usually on a $10,000 property, investors invest about a third, so about 3 million. Okay, so $180,000 worth of cash flow divided by $3 million invested, your return on your money is around 5.4%. Okay, and that will be your cash flow amount. Does that make sense? So we pay a lot of attention to NOI, okay, the net operating income. Okay, the reason is it's the only way to compare one property to another, apples to apples. Okay, we're just looking at your operations because some people may have a very large mortgage, some people may have a almost very low mortgage, some people may not even get mortgage, right? They just bought the whole thing outright for cash, right? So you don't want to compare whether a property is more profitable than another by factoring something like, mortgage. Okay. Also, different people choose to do different capital improvements. We mainly want to look at how profitable is this business. Okay, so that's why we look at NOI before factoring in all these other stuff. Okay, because my loan is going to be different than the loan that guy got, the seller got. Okay. So in a way, you're spending X amount of money to buy a business that is generating $530,000 worth of income. Do you see that relationship? Okay, so so therefore, we calculate the cap rate. Okay, so cap rate is basically your NOI divided by your purchase price, and that gives an indication of how much you're paying for a certain amount of income. Okay, the lower this number is, the more expensive it is. I'll give you an example. So cap rate is such an important concept that I dedicated 2 slides to explain to you guys. Okay, here we go. So let's say we have a property that is currently, has $700,000 of net operating income. Okay. Now, if you pay $14 million for this property, okay, so 700 divided by 14 million, well, then your cap rate is 5%. Okay, so cap rate is equal to NOI divided by the purchase price. Okay, so if you bought it for $700,000, I'm sorry, if you bought it for 14 million, your cap rate is 5%. If you were able to convince him to sell to you for much cheaper and you only spent 10 million, well, guess what? You have, your cap rate that you bought at is much better. The higher the cap rate, the cheaper something is. Okay. Now, whereas if a private equity guy comes in and then he's just completely overbids for the property, okay, same amount of income, but now he's paying $18 million for it instead of 14. So his cap rate is at 3.8%. Okay, becomes very expensive. So Amir asked, what's a good cap rate for Class B and Class C? Okay, so right now in Dallas, for Class B properties, you're probably looking at anywhere from 3.5 to 4%. Okay. For Class C, it's probably closer to about 5% in cap rate. And then for Class A, you're probably looking at about 3% in cap rate. Okay. If you compare that to San Francisco, in San Francisco, a Class A building is probably 2 cap. Okay, it's super expensive. And you can roughly equate this to type of return that you expect to get from the business that you bought. Okay, if you didn't pay a lot for it, well, you're probably going to get pretty good return for it. If you overpay for the property, then yeah, you're going to have a hard time making money. Okay, so your return is probably going to be a little bit lower. Okay, does that make sense? Okay. So once again, there's a prevailing cap rate for a certain neighborhood. Okay, so your broker or your property managers would know what is a typical cap rate that's trading in this area. Okay, so for example, if I use California example, okay, so cap rates in San Francisco is going to be like super expensive, something like 2%. Class B is probably going to be 3%. Even a Class C is probably going to be like 4% cap rate, right? However, if you go out into the boonies, like I'm just going to say all those are bad examples, but okay, let's say Fresno. Okay, Fresno. It's not a major city. It's not. There's no tech people there. Then the Class A over there will probably be like a 4 cap. Okay, you can get it much cheaper. Okay. And then a Class C property there is probably going to be like a 6 cap. Okay. Compared to, if you're in San Jose, it'll probably be like a 4 cap. Okay. So it changes on different neighborhoods, but the cap rate doesn't move that much. It doesn't move. It does move with the market, but it moves slowly. Okay, so this is a way we kind of value whether a deal is good or not, right? So for example, I know that for this type of deal, Class B should be about 5%. Okay, if the guy is asking for too much, then I know that nope, that's way below where I'm comfortable at. Okay, and then if I can get it much better, then that's a good price. So the thing to take away here is apartments are valued on their income. Okay, I'll show that on the next one. So here. So cap rate as a seller. So when you're selling a property, how much money can you get? Okay. So assuming that for your property, let's say you have a Class B in Dallas, the current cap rate for your type of property is 4%. Okay. So your selling price is your NOI divided by your cap rate. You see how I just kind of swapped it here? Just swap the price with the cap rate. Okay. So, if a cap rate is 4%, and then you're making $800,000 of income. Okay, so you would do 800 divided by 0.04. And then you would arrive at this business is worth $20 million. Okay. I hope everybody kind of saw how I did that. So $800,000 divided by 0.04, okay, is equal to $20 million. So now let's say you're a great operator, okay? Instead of bringing $800,000 of income, you brought in $1 million of income. You increase it by 200 grand, right? Well, the cap rate remains the same, right? So your $1 million worth of net income on this property, your property is now worth $25 million. Okay. Now, if you suck and then you run it to the ground and then you're only able to get $600,000 on this property, then guess what? Your property is only worth 15 million. Okay. Even though the cap rate, everybody say the same, but the value of the apartment is based on how profitable you are. Okay. So taken into as example, for every dollar that you increase in NOI, this turns into $25. 1 divided by 0.04 is 25. Okay, so for every dollar of NOI you're able to increase, you would increase your value by $25. And that is how apartments work. Okay, so our job is to buy a property that's either underperforming or has room for improvement. So we buy a property that's currently, operating at $800,000, and then we, renovate, okay, and then we can now increase rent. We can rent out storage lockers. We can rent out garages, for example. And now we have increased our income to 1 million. And now we have forced our property to be worth $5 million more. We did not depend on the market to say that, oh, Austin is going up. No, this is forced appreciation. Okay, we increase the cash, we increase the income, and therefore our property is worth more. Okay, and this is why I like apartments, because I can calculate out as a nerdy engineer what the business plan will be. And this is what each of the companies that you're working for is doing as well. They're calculating their income, their NOI, and how much their company is really realistically worth. Okay, so it's a business. It's not based on emotion. It's just business and numbers. I hope that's okay. Today's session is a lot of math, but if you have any questions, just feel free to ask. Okay, moving on. So typically, if I'm investing in a deal, okay, so you know, I like conservative underwriting, right? So there's certain things I like to see. Okay, so I don't want you to be too aggressive in the rent growth assumptions. Okay, so even though Dallas grew at 15%, Austin grew at 20%, but you know, don't use that as your real number, right? Because it's not going to continue to be 15-20% every year, right? So use a conservative number, you know, project that your, you know, the rent is going to grow at 3 or 4% a year, right? Maybe you can go a little bit higher for places like Austin, use like 5 or 6, right? But yeah, don't be, you know, I don't want the syndicator to show me something really aggressive. Okay. Vacancy. Okay, so everybody understand vacancy, but that's really physical vacancy. Okay, we talk about a number called economic vacancy. We're basically talking about all the money that you could possibly lose, right? So that includes bad debt. Okay, that includes physical vacancy, that includes bad debt, that includes you know, you had this apartment listed at 1,000, but you only rented it for $900. Well, you know, there's that's some loss there, right? That needs to be counted into the economic vacancy as well. And maybe you have to give concessions, right? Maybe you're giving away first month free, right? So economic vacancy is basically you have your maximum achievable number, and then you give it a realistic rating of like, okay, when I'm operating it, I'm probably going to have 5% physical vacancy. I'm probably going to have 1% bad debt, 1% concession, and maybe like 2% of you know, not being able to charge the maximum amount, right? So the reality is, you know, so you want to take that all that into account. So I see a lot of people, you know, assuming like maybe 5% economic vacancy or even 7% economic vacancy. I typically like to be more conservative at about 10%. Okay. I'll show you guys later in a chart on how much this affects numbers. Okay. Expense ratio, I like to see that it is at least 50%. Okay. Yeah, you can probably go lower on the class A, but a lot of times, you know, sponsors would cheat and they would put, you know, they would dramatically lower the expenses to try to make the deal look better. I don't buy that. Nope, at least 50%. Okay. Reversion cap rate. So we talked about cap rate, right? So, you know, this is assuming that, hey, when we sell, it'll be at 4%. But what if the market is worse 5 years down the road? How do you account for that, right? So we usually, you know, will say that, oh, if the current market rate is at 4%, I'll assume it's 10 times worse by the time I sell. So we would actually say we bought at 4%, but we'll probably exit at 4.4. Okay, 10% worse than where we are now. Okay, and if my numbers still work, that means that I'm able to absorb a market loss in the future. Okay. If the market stays exactly where we are, we made a lot more money, right? If the market, you know, went down even lower compared to where we bought it, then we made a crap load of money, right? But I always want to kind of assume the worst, and that is my projection. And then anything that we do better is a bonus. Okay. I also want to make sure that they have built up a reserve ahead of time. Okay, so you know, when you buy an apartment, you probably want to put away 200 grand, 300 grand as a rainy day fund, because guess what? Those people who did not have this rainy day fund would have really gotten burned when it came to COVID and tenants stopped paying, right? And then all of a sudden you don't have enough funds to operate your property. So make sure that they have plenty of reserves. A lot of times syndicators would not put down any reserves because if they raise too much money, the overall returns drop. Okay. And finally, I want to make sure they have a reasonable renovation plan, meaning that they're not going to say that, hey, I'm going to offer them internet and I'm going to charge them $200 a month for it. Not realistic. Okay. Or saying that I'm going to repaint the whole place and then that's going to cause me to be able to, push rent by $100. No, it won't. So I usually review their renovation plan and make sure it's reasonable. Okay. All right, so we're about to get nerdy, start looking at numbers. I think things will make a lot more sense, but yeah, just be ready. Any questions before we go there? Okay, let's go. So this is a spreadsheet that I use. This is an example property. Name is hidden to hide, to protect the innocent. So, so as an example, this is a property 1979 located in Texas. Okay. So let's say this property we're buying for 25 million. Okay. And we're going to spend about $855,000 in rehab. Okay. 184 units, which means that it's $135,000 a door. Okay. So, there's some parameters such as, we'll be able to get about a 75% loan on this property. The interest rates are going to be about 3.5%. For this property, I have reserved about $276,000 in reserves. Okay. That's about $1,500 a unit, et cetera, et cetera. Okay. So, you need to be able to do these kind of analysis. But basically, if I'm a passive investor, I'm looking at cost per unit. Did he overpay? Things like really expensive, like if you pay $150,000 a door for this, I'll go, ooh, knowing the market, you overpaid. And then I'm going to look at his loan. If his loan is too short, I get worried, right? If it's only a 1 year, 2 year flip, I get worried, right? If he has no reserves, I get worried, right? You need to raise these, you need to raise an extra $250,000 to make sure that you have reserves to survive a downturn. And then I'll look at his capital budget, right? So over here in capital budget, I have listed out all the things that we typically renovate. So granite countertop, $100, but usually you need to replace a sink along with it. You need to redo the plumbing. You need like another board underneath. So let's just say at the high end, $500, right? Okay, including labor. Okay, black compliance package, let's say on the high end, $750. Flooring to do the entire thing. So we're looking at about $4,000 a door for renovation. So we put away about close to $600,000 for interior renovation. Okay. In this case, I put down $500 for labor, but a lot of times our maintenance guys are able to take care of it. So these are all pretty inflated numbers, but I don't want to be low. Okay. And I do the exterior renovation breakdown. Do I need to do exterior painting? No, not here. Swimming pool, they're already pretty good. I don't need to spend money there. I want to add a pergola, dog park, need to redo the parking lot, et cetera, right? So for example, I want to add 50 extra covered parking, right? That I can rent out for $50 a month. Okay. I also want to make a bigger patio, do 30 of them. I'll be able to bring in $40 extra per month from that. Okay. So, exterior, I'm going to spend about $270,000. Interior about, yeah, $580,000. So my total capital improvement needed is about $850,000. And that would be the money that I also need to raise here, right? So how much do I need to raise for this $25 million deal? Well, we need about $6 million in down payment. That's a 25% portion, right? There's going to be about 3% in closing cost. Okay. If you're buying a floating rate, you need to buy an interest rate cap, and then plus your working capital reserves, right? So total for this project, you need to raise about $8 million to close the deal. He told me ask, are you doing bridge loans or can you finance your Capex or do agency? So there's a few different type of loans. Usually we get them from Fannie Mae and Freddie Mac, but they've been extremely careful during this COVID period and they're not able to loan very much money. Okay, so nowadays I would say 90 to 95% of deals are all bridge loans. Okay. So bridge loans can get to like 75% leverage or 80% leverage. Okay. So if we have the basics of this deal will probably return 12%. Not great. Probably not one that I would bid on, okay, because the return is too low. Okay. So I go into more detail about projecting what happens in year 6, all this kind of stuff, right? So we usually look at something called T12, basically how did this property do in the last 12 months? Okay. We also look at the last 3 months. Did it improve, right? Most property improved over the past 3 months, because during COVID, they didn't raise rent. They didn't try to, push the tenants very hard. There's probably a lot of delinquency. But over the past 3 months, things have improved a lot, right? So you'll see that if everybody paid top market dollar and every single person paid on time, no units vacant, then the maximum I could collect is $2.1 million, right? But you're never gonna be like that. There's always gonna be vacancies. There's always gonna be concessions. So they had about 15% economic vacancy over the past year. So out of the 2.1 maximum possible, they only collected 1.8 million in real net rental income. Okay. And then they collected additional money, from like, people paying for electricity, people paying for water, application fees, pet fees, parking fees, etc. Right? All these kind of different things, right? So altogether, their total income was $2.18 million in terms of income. Okay, so yeah, if you only want to pay attention to one thing, is pay attention to their gross income. Then what do you spend your money on? Well, there's insurance, there's property tax, okay. There is asset management fee. This is your property management fee, right? You had to pay for payroll, you have to pay for trash, electric, water, so utilities. You pay for landscaping, for emergency phones, for copier service, pest control, all this kind of stuff, right? So contract service over a year, is around $200 a door. So yeah, that's about right. Okay. So repairs and maintenance, things breaking down. Okay. And then make ready is basically when somebody moves out, you need to spend like about 2 days cleaning it up, trashing it out, painting the walls, and getting it ready for the next person, right? That has its own expense. So so I have my, for some of these things, I have my usual guidelines. Okay. So for example, payroll is usually $1,200 per door. Over here, they're paying $1,300. So that means, yeah, they're a little fat on the payroll. I can probably trim some there. Over here, they're paying way too much on the make readies. Okay, don't know what's going on. I can probably trim that and make it more efficient. Okay, because industry average is about $100 a door for make readies. Okay. So administrative, these are things like copiers, extra paper, just daily stuff, right? Also your legal, your accounting, all this kind of stuff, right? So expenses there. Then there's also advertising. Okay, they spend more than I would want to on advertising. So yeah, normal is 100 a door. They're spending $200 a door here. So yeah, there's things to be made more efficient. Okay. So in total, they had $1.2 million for expense. 2.1 million, about 2.2 million of income, 1.2 million of expense. So they are at about 56% expense ratio. Okay. On a per unit basis, they're spending about $6,700 a door. Okay. Yeah, that's not too bad. I mean, it's within range. Okay. So these are the kind of analysis that I do, right? And then looking at their trailing 3 months, they're doing a lot better. They're collecting a lot more money, right? People are paying up. They're able to charge higher rent, all this good stuff, right? So their income has improved a lot. And that's why their expense ratio went down, because they're bringing in more income. So based on that, based on their income, their NOI, and based on the price, now I can calculate what is their cap rate I'm buying at. Okay. So for this property, my cap rate is about 4.3%. However, we also adjust it for tax. So we make an assumption, if the property tax went up, what is the corresponding cap rate, right? So over here, we saw that, okay, so it's probably around 3.9 cap when tax adjusted. That's a purchase cap rate. Okay. Then in that case, when we sell, we're going to assume it's worse. So we're going to assume that it is going to exit at about 4.35. Okay. So my rent growth, I kept it fairly conservative, just 3% growth a year. Okay. Notice that my economic vacancy, if you look at their economic vacancy, it's 9.4% the last 3 months. Okay. However, when I take over, I always assume it's going to be much, much worse. The reason is, as soon as you take over some property, there are some tenants that knows that rent is about to go up. So they're already in the process of leaving. Okay. So when you take over a property, the first 6 months, there's a lot of churn, there's a lot of instability. So, and you're not going to be able to charge the new market rate that you want. So I always assume that, yeah, we're not going to get there in the first year. But in the future years, year 2 will improve further. And then year 3 probably get to our stabilization point of 10%. Okay. I hope this makes sense for everybody. I'm now going to show you how people cheat. It's a spreadsheet. You can make up any number you want, right? So it's knowing which knobs to look for. So right now, our average annual return is 12%. What if I'm very optimistic and I assume that it's going to grow at 6% a year? Or I've seen some people do 7% a year. So if we assume 7% growth a year, we went from 12% return to 34% return a year. Awesome, but also not true, right? So that's why be very careful when people become too aggressive on the rent growth. Okay, if you don't hit it 1 year, then you're not gonna get the kind of return that the guy promised you. Okay. Another thing people do is they're going to assume that they're going to run the property so efficient, there will be almost no vacancy, nobody will be behind on their rent, no delinquency, all that kind of stuff. So they would underwrite for 5% economic vacancy. Okay, so if I do that, my 12% return got juiced to 18%. Okay, so don't believe people when they bring this number down too low. Okay, I would say minimum 7 or 8%. Okay, you're always gonna have some vacancies, even in the best of times. Okay. Another thing that people do is then they mess around with a reversion cap. Okay. So remember I said that if we exited at a worse market than we bought at, then our return is 12%, right? Well, what if the market that we exit is the same? Okay, 3.95%. Wow, my return went up to 18% now. Okay. So, if in my calculations, if we are more conservative, we will always enjoy if things are better than what we expect, right? So, when I present my deals to my investors, because they trust me, they know I'm presenting real numbers. So when I tell them that, hey, the return that I'm comfortable getting is 12% to 13% a year, they trust me. They know that's a real number. Whereas some groups is because they don't have a lot of investors, they got to make the numbers look good, right? So they would mess around with this reversion cap. It's the same deal. Everything else is the same. They just change the exit value, right? Most people don't know to look at that. And you don't look at that, you will actually believe what they're saying, that the same deal is going to somehow generate 18% return. Okay, that may happen, but what if the market is worse, right? Then you're not going to get anywhere close. So I like people who will be more conservative and write for a worse number. Okay, what if the market becomes better? What if it went to 3.5, even lower, right? What if it's a better market? Well, then we kind of hit it out of the park. It's a home run. Okay, but I am not going to base my assumption on that. I'm going to base it on a conservative underwriting. Okay, and tell you that, oops, it should be 4.35, I think. Yeah, I'm going to tell you that, yeah, realistically, I think it's pretty safe that we can hit 12. We'll probably do better, but I think it's safe to hit 12. Okay. So as you can see, on some of these knobs that, the syndicators will tweak to make the numbers look better. But now that you understand, take a look at their rent growth assumption, take a look at their economic vacancy assumption, right? Take a look at, what are they buying at? What cap rate are they buying at? And what cap rate they're exiting at, okay? I would say these three probably controls the majority of the numbers. Okay. And then I can also juice up my number by, in my rehab, I say, oh, I'm only going to spend $300,000 in rehab. Oh, and all of a sudden it looks much better, right? But that means you're underfunding the deal, and things could go wrong. You don't have money to replace a chiller. You don't have money to, repaint the parking lot, etc. Okay. Or some people just say that, oh, it's a profitable property. We don't need to raise any reserves. The property will be so profitable, it will generate its own reserves. So they do that, and then all of a sudden you can see that the return jumps. Okay. So there's a lot of things that people do to make the numbers look better, but watch out for these, because writing conservatively will make sure that you're well suited for the risks. Like, for example, a lot of people ask me, any investment have risks. What is the risk in apartments? It's like, okay. The whole place could burn down. Okay, a building, somebody could leave their stove on and burn down a building, right? Okay, that's a risk, but then we can mitigate that risk by making sure we buy enough property insurance. Okay, well, somebody could fall on the stairs and then sue us for millions of dollars. Yeah, that could happen. It has happened before, but that's why we carry like a $10 million umbrella policy, okay, to mitigate that risk. Okay. What happens if if we hit a recession? Okay, well, first of all, apartments people still pay. So even if we drop 10% in occupancy, we'll still be okay. So for example, like over here, you can kind of go, so right now our cash flow is 300 grand, right? What if we went to 25% economic vacancy? Cash flow. We're still profitable. We're still above water. Okay, what if we went to 27% vacancy? We're still positive. So what if we went 30%? Okay, then that's kind of where we're hitting it. So we can stress test. We can stress test these business models, and we know that if the occupancy drops to like 70%, 71%, we're still break even. We're not losing money. Okay, we don't even have to touch our reserves. The property is still profitable, right? That's why apartments pay for itself, and this cash flow right here is a buffer for you for when things go bad. So, okay. And then, yeah, people ask you like, okay, what if it's really, really bad for a really, really long time? Well, yeah, then, we have our working capital and reserves. So when COVID hit, I immediately assumed that the world is going to end. My rental collection is going to drop by 40%. And then I looked at my capital reserves for that property. We actually had $400,000 in reserves. And I looked at it as like, okay, we can survive 14 months. Okay, if our collections drop by 40%. So having a reserve, because I want to sleep at night. So having a reserve is really good. Okay. So before I move on, want to leave some room for you guys to ask questions. So Hal has a question. How do you justify the spending on renovation versus rent increase? Okay. So I usually, for capital expense, for pool, for example, right? Generally, when you renovate an exterior, you don't usually see a direct rent increase. Okay. It makes people want to stay at your property. It makes people more likely to lease at your property, but it doesn't always translate to more money. You make money by renovating the interior. Okay. So how do I know how much rent I can bump by if I renovate the interior? Well, usually a neighbor would have already renovated their unit, and you can kind of see how much are they charging extra from their classic unit to their renovated unit, right? So if they're getting $150 extra for renovated unit, then that's how much you can get, right? That's the current market. You can also, you may have some renovated unit in your property as well, and you're getting like over $100 difference on renovated units. So there's demand, right? So you can judge it that way as well. But usually you can look at, hey, Joe next door, they're charging $1,400 for renovated 2 bedrooms. I'm over here charging $1,100 for a classic unit. Well, then I know that, hey, if I spend my money to renovate, I should be able to get to the pricing that Joe has. Okay. And that's how you can make your projections. How do you plan your renovations for forced value add when there are existing tenants? Good question. We smoke them out. No. No. So you only renovate the units when people move out. Okay. So on average, for apartments, you would expect to lose 50% of your tenants every year, right? So there's a 50% turn for your tenants every year. So in about 2 years, you should be able to renovate close to 100% of all the units. Okay. Another way, for example, like if I'm trying to renovate 4 units a month to hit my goal and people are just not leaving, well, then what I'm going to do is I'm going to raise the rent on the renewal. Okay. So if they're paying $1,000 now, I'm going to tell them that your new rent is $1,200. Okay. That's probably the renovated rent, right? I'm just going to charge them the renovated rent. If they stay, great. I got the higher rent without even spending a penny. I'll take that. Okay. And then if they don't, if they don't pay and they move out, great. I have a unit that I can renovate now. And then I can rent it out at the renovated price. So it's a win-win situation. So, when you're realizing that, you don't have enough units to renovate, yeah, you can be a little bit more aggressive with your renewal price increase. Based on your experience, what is the maintenance cost per unit per year for a Class C property? I would say, so typically we add the repairs and maintenance and make ready together. And yeah, it's more like about 300 per unit, $300 to $400 per unit for the maintenance of the property. But in apartments, it's not that bad. The reason is the bank forces you to put away $250 a year per unit into reserves to pay for these kind of repairs. So the lender don't want to lose their money. They want to make sure that you're spending money to renovate, to maintain the property. So they have this thing called replacement reserve to make sure that you're continuing to spend money. Okay. Any questions on the underwriting? Cool. I have a few more slides, but I think that's enough for today. I mean, I was gonna go into having you guys take a look at what a T12 looks like. So for example, if I just share this, this is what a trailing 12 months look like. So when we buy a property, we look at every line item, okay? Look at their trends over the past 12 months. We go over every single thing, like how much is the payroll? Are they spending too much, too little? How much are they spending on their marketing, line by line, not just like general categories. So we go over all of these and we look at the utilities in detail. And then we also look at what kind of renovations that they have been doing on the property, right? These are the Capex. Okay, so yeah, we take a pretty detailed look over the entire financials. We also look at something called a rent roll, right? But there's more black magic voodoo science there. I'll show it to you guys next time. Yeah, so at this time, I'll open up for a Q&A. Thanks everybody for staying on so late. Feel free to unmute yourself and ask any questions that you like. Will there be a link to the recording? Yes, there absolutely will. So I'll send it out. I know I've been kind of lazy, but I do have recordings for the 101 and 102. So yeah, once I get this uploaded, I'll share it as well. Okay. Do the property management company maintain the T12 statements? Yes, they do. Yeah, so yes, they do. They usually have an online accounting program that they give you access to, where you can look at the T12 information, right? See how the property is doing. You can generate all kinds of reports. Yeah, tons of good stuff. Everything you need will be on that accounting software. We use something called Resman, but there's many other platforms. So I usually go in there and look at it like 5 times a day to, to see like how is our collections going, how is our occupancy, and whether or not tenants have been paying on time. So that's also a place where you would review all the invoices that your contractors are asking to be paid. So yeah, it's completely up to the syndicator. Some people only look at those things once a month. They get the monthly report, they look at it and say, okay, it didn't suck. Okay, that's good. Or then there's people like me who is eagerly learning every single detail, right? So I look at it multiple times a day, down to every single detail, rent roll, even the work orders, I look at them. So yeah. So the nice thing is the property management company has a whole back office to handle all the invoicing, accounts receivable, accounts payable, generating these reports, making sure everything is entered into a system. So a professional, a professional system is property management company is really worth it. Okay. Yeah, and once again, I'd like to remind everybody, please sign up for the newsletter. We are working hard to get deals, and we may have something coming down the pipeline in the next 3 to 6 months. So please make sure that you are on the list to hear about it. Cool. All right. Thank you, Adriana. Yeah. Where do you get the detailed spreadsheets analyzing these? Yes, there are actually templates out there. Look up Michael Blank underwriting template. So Michael Blank has one. It used to cost $100. I don't know if he made it online now, but yeah, you don't need to subscribe to his courses, but he used to offer this template for like $100. That would be a pretty good place to start. But yeah, you'll end up modifying and making your own version to account for it. But yeah, these type of spreadsheets, templates, you can actually use it on any commercial property, right? Be it retail, be it office or whatever. It's basically the same concept. They're all businesses, right? Of you're calculating your income versus your expenses and calculating your overall returns. Right? So I have sections on capital. I have things on how the debt amortizes. I also have sections on how we calculate the yearly returns. Yeah, so for example, I also import the reserves, the rent roll, and then Yeah, rent roll is interesting. Rent roll basically tells you who's at the property, and you can look at it to see when they have moved in, okay, and what kind of rent they're paying. So many things you can do with the rent roll. You can figure out a trend of whether the rents are going up or down, okay. You can also figure out like, does the seller have a very high vacancy and then he's just stuffing the place with like really poor tenants in the last 2 months? Okay. You'll all of a sudden see that you'll see like 20 people all moved in within the last month, right? Then you know they're just trying to make their occupancy look better. And then you can go through another exercise of trying to figure out what type of tenants live at this property, just based on their last name, right? Is it going to be more Hispanic? Is it going to be more Caucasian? Is it more Black? Are there Asians in there? You get pretty good with names, and then eventually you start to go like, okay, so this looks like a predominantly Hispanic community. That's actually a great thing. Hispanic communities, they really take care of the apartment. They're great friends with each other, and they just overall maintain the property well. So. All right. Okay, I guess that's it then. So feel free to reach out to me if you have any questions or you want to connect for some chat. Always happy to chat. And yeah, any questions you may have, just let me know. All right. Thanks, everybody. Bye.